let's look at the Volatility Index, and we will look at a leveraged way to get exposure through the UVXY. First off, read this disclaimer carefully, and do your good deed of the day by liking and subscribing. So first, let's look at the VIX. Here it is, the S&P 500 Volatility Index, basically at the lows, very far away from the 52-week highs. If we look at the leveraged alternative, we'll get a very similar message, but of course we do get the leverage effect. So this is the one we will look at as a leveraged play. But the VIX, of course, the basic index will be what we analyze. So here we have the VIX seasonality, the percentage of months in which it closes higher than it opened. And you can see here that there definitively tends to be a significant increase in the VIX heading towards the summer period. However, the current period, spring, is seasonally low VIX. So that's interesting. What is a bit paradoxical with our current time is that, and that is something we see across market indexes, and that is this truncation or compression of time. Hence, the seasonality could be messed up in a way that it hasn't been before. The key thing to know about the VIX is that it is a measure of the expected price change in the S&P 500 options over the next 30 days. And that is basically why it is called the fear index, because it measures implied volatility. And as you can see here, we are at a very, very low level historically. So there is complacency in the market, not much expectations of a spike for sure at this point. If you look at some previous times in the market where we had very low VIX. So here I have the Volatility Index in black, and I put the S&P 500 ETF here in purple. So this is a time of here is you have very low VIX. But what is very interesting is that even though we did have a big bull market leading up to the dot-com bubble, we see that the VIX did rise. We were actually at an elevated level here of VIX, even though the market went up in a big way. And then, if you can see here we have, the top of that bubble. And here you can see, the VIX. It stayed at this elevated level. It certainly had spikes, as you can see, during these plunges. And when, the new bull market came on the horizon, the early part of that bull market, you see that then VIX get into a very low territory that we saw back here. So you can see that there is this trend. And then when we get into the later part of that bull market, you can see that the VIX gradually started to pick up before we had, that waterfall crash during, the housing bubble. And during the housing bubble, we can see here that the VIX spiked far more dramatically than it did during the dot-com bubble. And then we see something rather interesting. If you look a bit like this, it's a bit wonky here with the charts, but here you can see. Very interestingly, when we reached the bottom during the financial crisis, the VIX was actually at a very high level. And it stayed rather elevated. So the bull market after the financial crisis was very characteristically different from what we had certainly after the dot-com bubble, where the VIX was very, very, very low. So here there's a lot of calm, but here you can see it quite clearly. I mean, in the initial period, there was tremendous uncertainty. And then we do get a far more complacent period. Something you can see that there's been a bit of an overall increase here in the VIX. So here we have very low complacent levels, a bit of an increase, and that is something we have seen before. Way before there is like a big crash, a big bear market. Then of course we do have the situation with the contagion. I don't count that really as a bear market because it was more like a temporary crash. You know, a bear market is it is characteristically different. It's more like an overall dynamic end to the expansion part of a business cycle. So it is different. So you can see here that even though the market has been going up here, you know, in a very dramatic way. I mean, we've seen a very huge breakout above these highs. So you might think that after we made new highs, that, you know, investors would be far more complacent, but certainly it seems that there is some skepticism. So the VIX is still elevated. So going back here to the VIX. So we are currently towards the low end of the RSI. You can see that there is virtually no direct correlation long term. Looking at the daily data points, like this, we do have a minus 56% negative correlation, but it is not like people often think. You know, they think that there's a perfect negative correlation between the S&P 500 and the VIX. That is, you know, scientifically speaking, not the case. So yeah, we are at a very, very low level here. But we need to look at the stock market index to really, you know, make some conclusion whether we should expect people to become more afraid or not. So let's now look at the correlation between the VIX and the UVXI. Like that. And then we have the UVXI here in the foreground. So we do see, if we go here first, long term, there's only a 16% positive correlation between the VIX and the UVXI. So there is a significant tracking error. Looking at the short time frame, there's some. So from the long term to the short term, we go from a 16% positive correlation to only a 56-ish%. We would ideally, of course, want to have a very strong correlation, like in, you know, the 90+ range. So there is very dramatic tracking error. This is one of the reasons why there's a lot of people who have made a lot of money shorting the UVXI, because they just bet on that deterioration continuing. And also, you know, you have people, you know, selling all kinds of options against it because of that decay. However, when the UVXI goes on a spike, then you have situations like this during, you know, the C plunge, where it goes up over 1,000%. So you definitively do not want to have any infinite, unlimited risk strategies when you are trading this in instrument. Even though, yes, you can expect a decay, but it is just dangerous, because during this period there were people who had, you know, made a living betting on the deterioration of the UVXI, who had like their accounts literally like blow up in a moment. Yeah, and those accounts, you know, they just are not going to recover. So when we look here at the S&P 500, so let's go way back in time here. So when we look at the distance from the 200-week moving average in red, we can see here on the PPO, we are at a very high level. There definitively is complacency in the market. Looking at RSI, it is also at a rather elevated level historically. We can see here, if you look at some of the key moving averages, like the green 50-week moving average, test, it's a very common, here again, test, it's a very common level for us to test. And if you compare the prior times with the current time, this is a rather stretched rally without us visiting that moving average. So here I have drawn in some prior times from we tested the green 50-week moving average to the high. So 238 days here, 616, this was a long period, 44% gain, 217 days, 13%. Here we got 40%-ish, 448 days, 168, 14%, 252 days, 22%, and in this instance we have 30%, 266 days. So you can see that, you know, 30% compared to some of the prior times, this is at one of the higher gains we have seen since the bottom of that you know, bear market. Hence, you could certainly make the case that this is one of the most stretched periods, And if you look at some of the prior times, like this one, you know, from testing the 50-week to the temporary high, then we did have basically have a crash. Another period where we had a longer rally in height. You had this period, but this was over a much longer time, 616 days. Here is just 266. This has definitively been much quicker. And when you look at time periods as well, you could certainly make the case that when you look at both percentage and the time, this is a very fast time frame. Hence, I think that there's a rather high probability of a very meaningful pullback on the horizon for the S&P 500, which would trigger a spike on the VIX and be, you know, bullish for the UVXY. So the seasonality suggests that there could still be some time until that happens. But the paradox, you know, as I mentioned initially, we have seen in so many markets that time has become compressed. Hence, seasonality that we usually would expect to come in a few months, it could actually be coming much earlier. So that is just something to be very aware of now. Yeah, be on the... So when it comes to the UVXI and the VIX, I'm definitively have my bull radar quite active at the moment. I'm not saying it's going to spike right around the corner, but at these levels and based on the data we did look at, I think there's good reason to be more contrarian when it comes to the VIX when it is at these very, very suppressed levels.